great to see everybody. It's been awesome doing our presentations in person again. We're going to start today a little differently with some trivia, okay? And there's a grand prize. Who's ready? One question. Are we ready? What does FIP do for its clients? Raise your hand. What does FIP, guys, my website, every phone call, I'm not doing a good job. Let's get three guesses. What is that?
Sure, we're enjoying life.
No, not you, Keith. Oh, I'm sorry, Karen. Guys, I apologize. Question again. What does FIP do for its clients? John was very good. Karen? Capability. That's very good. That's an older one. That's an old team. No, that wasn't it then. Come on. Couple more. Anyone else? We're gonna do one or two more. What? That's you're right there. And there we go. The grand prize. I have driving here, and I was like, it should have been because you guys helped each other. The grand prize. Yes. So every time I'm training my team, I always, ask them similar questions, and the prize is always a Snickers bar. So I was like, you know what? I want to start today a little differently. Also, I bought like a lot extra, so if other people want, I got it. But that is exactly when you think about financial planning, when you think about what an advisor does, they manage my money, they help me with tax planning, they make sure that my accounts rebalance. But what do we really do for you and all of our clients is we help you worry less and enjoy life more by giving you confidence. Your money's going to last the rest of your life and you can maintain your lifestyle. Now, for compliance purposes, I will add, and if you are not on track, we give you recommendations and what you need to do to be on track to your long-term goals. Our experience is so unique, not because of our investments, not because, we understand taxes and help you with your estates and all these really, I could keep going, wonderful things. It's because we empower our clients to have better lives. By doing regular reviews, to give you that confidence you are on track, and then remind you we have a lifelong relationship with each of you to be by your side the rest of your life so your plan stays on track, so you continue to have the best life. This is so unique about us. I'm so fortunate I get to train with a lot of top advisors, and I don't think many people deliver what we do. They have the models, they've got some of the software. We over-deliver, but we over-deliver in helping you guys truly enjoy your retirements. And I couldn't be more proud of that. And I hope you all truly feel that when you have your review calls or when you even think about FIP. It's interesting. I had an email the other day, and a lot of advisors or, business people, they have little taglines when they sign off. It says, the greatest thank you could give us is a referral. And guess what? I love referrals. But I have many meetings, and it really hit me. I was reading this. I said, to me, that is not the greatest thank you I can get from somebody. The greatest thank you I get, and my team gets, is when I finish a call or I just call somebody on their birthday and they say, Jared, we are enjoying our life. Thank you. Hearing from my client that I'm delivering everything I envision FIP delivers will always be the best thank you myself and my firm can get. Having said that, we will still accept all the referrals. Briefly, I just want to say, as many of you know, we're celebrating our 30th anniversary. Absolute milestone. I won't get into all the ins and outs. For a company to even make it 5 years is quite a challenge. 30 years, 800 clients, and this is my favorite part of everything I said. Helping 800 different families and individuals live better lives. you want to talk about somebody who feels like they have the best career in the world? That's me and my team. And as I always say, our promise to you guys is for the next 30 years to only get better, increase our experience for you. So you see you're with a firm that's not just happy with what they're doing because it is great. It's they always want to get better for us. So I want to thank you for your business, for your partnership, and just for the relationships. I mean, I love just calling my clients and before we get into all the numbers, I love hearing about the travels, the grandkids, when things are good, when things are bad. We're here to be by your side through all of that. So just thank you for everything, really. First, I'm going to introduce Miles Mini Master. He's with MFS. I've actually known Miles my entire career. He's always been an excellent partner to us. MFS is a phenomenal company, extremely long track record. They've been an important partner to us for over 20 years. If you guys have known my dad long enough, back before we had our diversified models, it was just some MFS position. So they're still doing great. And Miles has tremendous insight. So let me introduce Miles.
Yeah, MFS has been around for a while. Just a little FYI, we are the first mutual fund. So I want to say we have been around for a while. So yeah, I'll say that. So yeah, been a great partner with this group, and it's been a great, enjoyable run with them, and they've been so consistent. And I think about the firm itself. I can't think of I deal with everybody in the Philadelphia area, maybe 3,000 advisors, institutions, and pensions, and I would say these guys are on top of the game. I mean, they're on the forefront of planning, and that's why we work with them. So we're doing a little bit different. Myself and Dan over here is going to talk a little bit later. So I figured my opening would be sort of let's talk about what you guys want to talk about. What's interesting you? Like, is it the big beautiful bill? Is it gold? Is it Bitcoin? Is it tariffs? Is it AI? Is it healthcare? Anybody want to stop with one of these breaks? Because these are big trends that are going on that are not going to disappear, but I think it has big outcomes in the future. So does anybody want to start me on one of the top? Go ahead. So the first is, so what, any specific parts that you want me to address? Like, one is this Social Security, right? You saw that up to $6,000 that you get as a benefit, did not have before, which is nice, right? But when you watch it all through, it's maybe up to $6,000 on Social Security that you get for free. Well, you get a break on, you don't have no tax on. So, which is great, right? So there's a good starting point. Is it what the original proposal was? Is no tax on Social Security at all. Sort of went through the machine and sort of got watered down in a lot of different ways. But that's part of it. You'll be taxed on some of it, yes. Depends on your income and some other different things. But yes, you have an additional benefit which did benefit the senior taking Social Security. How much it is depends on tax and other situations. That would be one of the things, which I think is a nice thing. It's a good start. Oh, these are related questions. Okay, so I just got a Zoom request, just so you know. The question was on the big beautiful bill, how does it affect on Social Security? And so that was the question. I don't know if I should re-answer the question, but essentially you get a $6,000, some kind of deduction on your tax.
That phase out.
And it's a phase, and it's an income level too. So it all depends on your personal situation, how it's situated. But it's a benefit. Let's put it that way. How much depends on each person a little bit, right, Keith? So that would be one. So a couple of things that I would also think about. So if I'm a kid, a newborn, so if you have a child or a grandchild that's a newborn, they're going to get $1,000 that they get to put into the marketplace and for every newborn in the United States, which is a big thing to get people adjusted into the system and understand if I own stocks at a very early age, they get some kind of benefit in the future, which is a great thing. I've been waiting for them to do this for years. I think it helps the younger person to learn how to invest because we see the gap in the younger person. There's just a big gap that they don't learn to invest early enough and see the long-term outcomes. As you know, as long as you've been with this organization, you've been able to see appreciation over a period of time, which is great. What, do you have a question for me? Oh, okay. So another thing that I think is important that most people don't think about, healthcare. There's some reform in healthcare. Some of it is good, bad, and ugly, but I'm going to say for what is good. One of the things that's in the proposal is if you go to a doctor and you get an operation, you just get one big bill, right? You don't get the itemized bill. It's very hard to see all the different procedures you get and what the real cost is. One of the things in this bill is actually disclose what some of the costs are to get an operation done. So I was talking to my boss just the other day and we were going over this sort of premise. And she goes, I used to be a nurse. And I'm like, really? And she goes, in my earlier career, she goes, 18 years ago, for one Tylenol at a hospital, it costed $18. Yeah. And to be able to see that and for the consumer to question that may help reduce some of the healthcare costs in the future. It's going to take a little time to get through, but I think everybody wants to see what their bill is when they go to the hospital. So that's 17% of the overall GDP cost in the United States is healthcare. If we can reduce it by a little bit, it's a big benefit. Another thing that they did on healthcare is if I go to a doctor, we know how you go to a doctor. You got to, the doctor says, hey, I got to make sure this procedure be able to approved with your insurance company. And we got to call back and forth, right? We know that. Mm-hmm. That's been eliminated also. So that's going to take time. So what they figured out, it takes between 15 and 20% of the nurses and the doctor's day in cost. If we can just reduce that a little bit, guess what? To the end consumer, maybe it will start bringing down a little bit of the cost in healthcare. That's in a big, beautiful bill. Now, one of the things that I think most people don't think about, and this is really interesting, you can deduct, if I got a company, a manufacturing company, I can deduct 100% of my machine. Now, what does that mean to you and I, right? So unless I own a business, I don't want to deduct all the stuff. It doesn't mean much, but at the end of the day, if I'm a corporation, I can retool, buy better tools and machineries and spray guns and paints. And if I'm an EV manufacturer, and I need new tooling, I can start deducting that right away. That is a huge growth potential for the United States. Huge pro. I mean, Keith, you used to be an accountant, right? That's a positive thing going on for the market. So that's something most people don't think about. That's going to take time to enact. But for the average consumer that's invested in the marketplace, this is a big deal. It's a very big deal. So don't discount what those small little changes are. Another thing that's going to happen in the big bill, beautiful bill, is trying to think what the other one I had for you. It pertained to business specifically. I can't think of it, but I'll get into that a little bit later. I'll figure it out, but there's a couple other things that pertains more to the consumer, the end user, and that's a good thing. So one of the questions I always get, my gosh, they're overspending money, which you hear about the big beautiful bill, which there's a degree of that. Yes, it is going to be more expensive. They're going to spend more money, but it's going to be directed to the consumer, not through the government. That's what you got to think. It is a pro-business, pro-growth type of bill in the way it's set up. That's what you got to think about. So, give you a little bit of this is sort of an anecdote that I think you should pay attention to. So when they have a stats called debt to GDP ratio in the United States, right? So how much debt to what the growth is of the United States is. And I think that's sort of an important stat because as the higher we get, it's a crowding out effect because the cost of everything in the United States costs so much, they can't get out of their own way and it becomes sort of a debtor's nation, which sort of happened in Japan, right? No growth for a long period of time. We're at a point where that growth stage is on the cusp of being sort of a debtor's nation in a sense, without going into too much of the details. The way this bill is structured is to be very pro-growth, is to grow out and to get more GDP growth and slowly bring down the debt over time. That's the way the bill is structured in a fundamental way. And they do it? I don't know. But it will be deceiving. And they're doing things I think that makes sense fundamentally to get going. Some of it's not great, but some of it's pretty easy. So keep that in mind. Harry, can you mute that phone, please? Good job.
I don't know that.
So that's part of the big beautiful thing, right? Another big trend. Anybody got questions on that? Another big trend that I don't think people are thinking about. It's this deglobalization that's going around the globe. So if you think about supply chains, right? Where I got my goods and services from over the last 30 years, and I wanted to buy a mask, for example. I would probably go to China because they had the supply chains were set up in the way they work. And you can do it. What happened in COVID became very, very interesting. What we found out is we were, as a country, at risk from a supply chain sense. We couldn't get the goods when we needed them, and there was a pushback on it, and we couldn't receive it. So what you're going to see in the future is a deglobalization, or I'm going to say it's this way. It's going to be a decoupling from existing supply chains to new existing supply chains. That we think we have a better way to get our goods and services. So that causes friction in the system, but net result is you'll see a decoupling. And so countries will be more polarized, and you see that going in the United States, but let's don't fool ourselves. This is going on in Europe, this is going on in Asia. It's the same thing across the globe. What I have, I want to keep a little bit more of what I got. Now, is that bad? Potentially it's bad, but there's a lot of goods within it too, because we create new avenues to get certain alliances together. So this deglobalization thing is a real deal. Another thing that's a big trend is technology or AI. Who uses AI? Big adoption in this room. There's a big adoption. What you do?
Well, I say all of us do.
Okay, good.
You can't get away from.
Yeah, so if Jared said it or Harry said it, you were talking about going on vacations, right? If you go do one of these ChatGPTs or Grok or one of the other things, I just want to show you the power of AI. So I came back, I went to Sicily over the summertime, a couple months ago, and I'm with a client and I'm sitting there talking about, going to Sicily, and he goes, my gosh, Miles, this is sort of a bucket list to me. So I went on ChatGPT. And I said, I'm going to Sicily in the fall. I want to stay in Taormina. And I want day trips back and forth within a day. Can you give me an agenda for a week? It was 3 pages long. How long did it take me to do that? Less than 2 minutes to type it in. So if you're not using it and you think of out of the box ways to implement it. Now, so how businesses use it. Now, this is sort of fascinating. Another story personally about me. Does anybody own a Tesla? No one owns a Tesla. Interesting. Not a bad thing. I mean, I didn't own a Tesla until just recently. I happened to have some time. My son bought a Tesla, and I was thinking, hey, let me go check it out. So I was in Wayne, where the Tesla dealership was, right? And I go in to go sit in the car, see if I could fit it. It's a little bit bigger guy. And sitting in the car, and hey, you want to do a test drive? Well, let's do a test drive. I said, buddy, I'm busy. I got like 15 minutes. He goes, okay, don't worry about it. Don't worry. I want to show you this. So I hopped in the Tesla. He goes, sit in the driver's side. Promise me you won't touch the wheel once. I said, are you sure? And he goes, no. He goes, I'm kidding. He goes, no joke. He goes, okay, fine. So he goes, let's go to Wegmans. With anybody knows, from Wayne to Wegmans, it gets pretty busy, and it's not sort of an easy route to get there, and it gets pretty. Anyway, so we pull out of the thing. I don't touch the wheel. We start shooting down the line. I said, hey, wait a minute, it's going a little slow here. I said, I don't know if I can do this because I got to get back. I'm sort of busy today. He goes, oh, don't worry, Miles. Press the button on the computer screen, and all of a sudden it goes to the fast lane and starts going way quick. Whoa, wait a minute. So we go through the valley, get to Wegmans. He goes, we stop right at the Wegmans door. He goes, get out of the car. I said, okay. So I get out of the car. He pressed the button. The car goes and parks itself. He goes, okay. Press another button, comes back and picks you up and drives me back home. Never touched the steering wheel. Think about the implications of that alone. Think about if I needed to go to the doctor and I'm in a car that has this kind of capability. All I do is press a button and it'll drive me there. If I want to go out to a restaurant at night and have a drink at night, I press a button. Yeah. Think about the change that is versus a traditional car. And I was sort of blown away. I actually bought a Tesla, believe it or not, after I did that. So there's my story about the Tesla. But I think about the technology that is moving and how fast it is. So anybody know what an IPO is or an initial public offering of a company? So when I got a company that's a private company and I want to go public, right? You have to get a bunch of lawyers, probably 15 to 20 lawyers, to do all the documentation. And you go write this up, and it'll probably take a little over a month of 15 lawyers just to write the documentation up, full time for a month. They threw the documents, and they said it's Goldman Sachs. They threw the document in ChatGPT, or one like it. I won't say ChatGPT. It popped out 95% of the document in 1 hour. 1 hour. Think about that, and for the future, and how much changing is. And so there's a risk to this, right? There's also a risk in this. The risk is if I do traditional lines of businesses, that's why when you talk to Harry and you go over your portfolios, these companies are changing all the time. So if I look at the traditional, so who do you do your search with on your search engine when you do a search on the internet? Google, right? Guess what? It's starting to diminish. More and more people are adopting to ChatGPTs or the AI websites instead of using Google because they find the information better and more accurate. So you see the search engine. So when you got a diversified portfolio like this, it makes a big difference. Good question.
You're not driving that Tesla. Sitting behind the wheel. You are charged with DUI.
That's a question I don't know because I haven't tried it out myself. But if I do try it and I get caught, I will make sure I'll come back and make sure I'll ask the question. I don't know that. I actually asked the same question. I don't know if you're liable for that. I'm not sure. Well, it's a great question. Do you know? Do you know, Dan?
I'm pretty sure you are.
Wow. All right. So don't use it if you're going to. Keith, you had a question? You have a question?
Well, Tesla drive if no one's in the driver's seat. You can sit in the back.
So as of like the next couple of weeks or a month or whatever, so Tesla, if you buy a Tesla car, they got a little computer screen in the back of the car. So what they're rolling out. So if I own a Tesla, I park my car at night, right? And I say, you know what? I don't want to make it a taxi. You press a button, and all of a sudden it starts shooting out. And it will be like an Uber, and it'll pick the person up, no one in the car, do its route, and then come back home. And you get paid for it. That's happening as we speak. So when I look at technology in this way, I look at opportunity, whether Dan and asset allocation, I look at the opportunity in all these things and say there's a changing situation going on around the globe, and it leads to real opportunities in the future. That's what I think that you should take of this message, whether it's the big, beautiful bill, whether it's deglobalization, whether it's AI, whether it's, by the way, healthcare, which, and we all know like Ozempic and the difference of the drug and what kind of benefits it's leading to in the future of longevity. It is a quite interesting way that when I'm looking at healthcare and how fast it is advancing. All right, questions, and I'll bring Dan up here right after that. Question, any other questions? Bitcoin, anybody got questions on Bitcoin or gold? I usually get that one every time too. Nothing. Okay, so I'm going to bring Dan up here a little bit. He's going to talk a little bit more specifically about opportunities within different asset classes, within portfolios, and I think that's important. I would say in this kind of environment that we live in today, I think the more diversified you are in portfolios and look for different asset classes and different opportunities, I think you will be in much better shape. And I know looking at the portfolio design that this group does, I think you're in a really good situation for that. If I am thinking of it, if I'm a non-diversified, I have over concentration risk, which there's some in the market right now currently, But being diversified is a key part of going forward, because I do see a lot of opportunities across the board, everywhere. Yeah, Harry.
So just appreciate this question, very interesting. Just, but what do you see, what's MFS see? I mean, it's $2 billion, but what do they see in the market next?
So if I'm looking next couple of years, it's interesting. I'm gonna cut it down in a nutshell. We see profit margins getting their extreme levels. We see that coming down to a more realistic number. We see from the deregulation and some of the growth policies, we see opportunities in smaller company stocks because they will benefit. We see interest rates going down, not to the floor, but we see interest rates going down. We see there is an impact for tariffs. Is it extreme inflation? We don't see that. Is it sort of an inflation? Because remember, tariffs are taxed. And it's a discretionary tax. So if you see a good or you buy a car, let's say Japan, and there's a 15% tariff on it, you look at the price and you say, here's a substitute for a GM car. You're going to discretionarily move your assets to where you think you'll get the best home for it. So when I look at tariffs, it's not necessarily inflationary across the board. So it's going to be a moving target over probably the next couple of years until we figure out sort of who the winners and who the losers are. I think we can do the analysis pretty quickly. But if I'm looking net overall, well, I'm pretty favorable of United States. I'm favorable of international, which I didn't talk too much about, but there's a lot going on international that I think there's some real opportunities, because some of the countries are playing a catch-up game to us. And we know, like, great. So if I look at in a quick little snippet, energy and technology are part of the future, whether we like it or not, right? If I win in energy and I win in technology, we win a $245 trillion run for the next 20 years, which is great for everyone. We know China's doing the same thing. They're on a mad chase like we are. We look at Europe and they're fumbling. And quite frankly, and they have an opportunity because the way they're putting in policies to build an opportunity on this. Unfortunately, they're slow to the pace, but they know they got a problem. And I'll give you a quick example, right? So let's just make a thing. If I got to build a widget in the United States, energy cost and the widget cost $1 to build a widget. The cost of energy in the United States is 7 cents out of every dollar cost from energy cost, right? Everybody understand? If I go to Germany, cost is around 22 cents per widget. They can't be competitive. Now, they went all in on this green energy story. Not knocking green energy at all. But I want you to ask a question. Anybody been to Germany? Right. Okay. So what are a couple of things? Okay. So they put a bunch of wind farms all over Germany, right? To reduce energy costs, be green energy. What's the problem with Germany? It's mountainous. You don't get enough wind to consistently to actually bring down the cost. You also put a bunch of solar panels up. Okay. What's the problem with Germany? It's overcast half the time. So it's sort of an inefficient use of energy. Now, they know this, and they're trying to play the catch up. So I look at like that kind of scenario over in Europe, there's a huge opportunity because it's cheaper in the United States. Fixed income, I think there's a good opportunity in fixed income, certain asset classes a little bit more than others. And that's about it. Harry, any other questions, follow?
So generally, cautiously optimistic.
I will say, I am.
Or you're more than
Here's what I'll say in a different way.
No,
Here's what I'll say.
guarantee.
Great, that's a great question. It's a great question. I like some of the, I'm the top 7 stocks in the United States are expensive. Underneath those top 7 stocks, it's actually pretty reasonable. I love the companies in the top 7. I just don't like the price I'm paying. So if I have a diversified portfolio, I eliminate a lot of that risk in the portfolio. And when the price changes in different asset classes, I can benefit. But that's why I'm cautiously optimistic. We're just a little pricey on common stocks. And it is sort of running the market right now. All right, with that,
We do have two
oh,
suggestions.
go, okay.
The first one is SEC 6,000. Is that in addition to what I normally receive that is not taxed?
So that, oh,
If you understand.
so what is what additional benefits does he get?
Well, is that in addition to what I normally receive that is not
Social Security 6,000, is that?
in addition to what I normally receive that is not taxed?
Well, it's, yes, it'll be, you're gonna get the $6,000, which didn't exist before.
Okay, and then for,
But it has requirements on there, yeah, it's a deduction, but there's requirements on income, and so each person, it's a sliding scale, so when I say $6,000, it's not gonna be $6,000, that's the way the government works. There's gonna be, you probably receive some benefit. How much that benefit is, when you talk to your advisor, you'll have a better idea, they'll have a better case for your situation. Do it that way.
and then the next one is AI generated IPO docs. Is there any research on the number of personnel who will need different jobs?
Ooh, but not to be seen. That's a great question. So there's a stat out there that they think within 15 years that 40% of all jobs in the United States will not be needed because of AI. Now, you can go back through time and you can look at different periods of time where we've had innovation that jumps in. And yes, those jobs may be gone, but there are new jobs being found or created. So if I'm more productive, a new job comes online. And so I'm not so worried about that, that stat right now, but there's no doubt it's going to change some of the methodologies of how businesses run. I would say client-facing people are going to be in the most demand. The people that can know how to interpret AI, the person where they think they can be replaced by something, that I'm going to say they're probably a little bit more at risk going forward. That doesn't mean they can't find another job. It means they may have to retool themselves and look for a different job. So I'm not worried about it at all, because we've always found new technologies out of it and we get good growth out of it. So I think that it's just an evolution out of it. All right, I'll let you guys go. Appreciate it. Thank you.
Thank you much. You know, it's interesting. I was actually having this conversation because I follow the AI stuff pretty closely, and I was talking to my friend's dad, who's a pretty sharp guy, and I was like, you know, AI, it's amazing, but it's a little scary. He's like, yeah, how scary do you think it was when the Industrial Revolution happened, and all these people were like, look at this change, and where are we now? And then what was next? Oh, computers. Well, now we're out, you know. So I am confident, based on what he said, that, you know, this is just natural evolution that happens and changes happen, and that we continue to adapt. And how much better is our society from the Industrial Revolution and from computers, and hopefully, you know, AI, that will continue. So Miles did a great job. Dan Shannon with Janus. Many of you have the Janus Balance Fund, which has consistently been an unbelievable part of your portfolio. Janus, again, is a amazing company with an extremely long track record, tremendous amount of, you know, CFAs and very smart people, and they work round the clock as we get to, you know, enjoy this nice afternoon as you guys go on vacation. Dan and his team are constantly looking at the portfolio and making those adjustments. And that's why they have a 20-year track record, or long, Janus Balance, probably longer than that, 20-year track record, which is something that's very important to us. So I'm really excited to bring Dan up and share his insight. Dan?
Are we okay if I'm not in front of in back of the podium? Can you hear me okay?
Good.
All right. My parents always told me I could project. Although now the people on the Zoom can't see, I don't know if they need this thing.
I can turn you if you want to go here.
No, that's okay.
Okay.
I'll hang back here. I won't make it more complicated than it needs to be. So first and foremost, thank you for having me here today. I sincerely appreciate the opportunity to be in front of this group. As Jared said, my name's Dan Shannon. I am an executive director with Janus Henderson. If you're not familiar with Janus Henderson Beyond the Balance Fund, we are a $375 billion global asset manager with disciplines across equities, fixed income, multi-asset, which is where the balance fund would lie, private equity, private credit, a number of different strategies. 9 different offices across the globe. We're headquartered in London, with our US headquarters in Denver, Colorado. And in my role, as Miles, identical to what Miles said, is I work with financial advisors in southeastern Pennsylvania, southern New Jersey, and Delaware. And I'll echo what Miles said. Having the opportunity to work with the folks, Harry, Jared, and of course all of the great advisors at FYP, they are the very best at what they do. We get to see behind the scenes the care and the thought and the energy that goes into every decision that they make on your behalf is second to none. And I can tell you, and I appreciate Jared's comments about the balance fund, if there's a stretch where maybe the performance isn't up to their standards, they're going to ask me the hard questions. They're going to hold our feet to the fire to make sure that we are doing the absolute best that we can on your behalf. So you are in great hands with these folks, and we do get to see all of them. So there's 3 things that I wanted to do today. Number one, I'm going to talk about a sector that has been mentioned several times already. You can see what's top of mind in the investment industry right now, and that is AI. Secondly, I'm going to talk about what I would say are the vital signs of the economy, and then close and ask any questions or comments or thoughts that you may have. But first, God bless, very similar to Jared, I wanted to start with a trivia question.
We have more Snickers.
I didn't bring any, so I'm glad somebody brought prizes. All right, so we're all familiar with the S&P 500. That is an index which is the 500 largest publicly traded companies in the United States. And so the top 10 holdings in the S&P 500 are the 10 largest stocks. So the 10 largest stocks today, let's take it back 10 years and look at the 10 largest stocks back in 2015. And then let's take it 10 years further back and the 10 largest stocks in 2005. There is only one company who was in the top 10 today and in 2015 and in 2005.
Microsoft.
Wow, how about that?
Hey, look it up.
That's ChatGPT.
Yeah.
It is Microsoft. And I take 2 things away from that stat. Number one, Microsoft is an amazing company. I mean, 20 years is getting to be a long time now. And technology has changed a whole bunch. So it's just a credit to Bill Gates and Steve Ballmer and now Satya Nadella and all the people at Microsoft who've just done an unbelievable job over the history of that company. So that's number one. Microsoft is amazing. Number 2 is that's pretty incredible, isn't it? That there's only one stock that has been in the top 10, the S&P 500, over the past 20 years. That's how quickly things change. And when we think about it now, so much of the conversation in the stock market has been about how much the top stocks in the US stock market are driving the returns for the rest of the stock market. For example, 2024, over 50% of the return of the S&P 500 came from 7 stocks. So it's been very concentrated performance. So for me, it's hard to believe. You think of those 7 stocks, just take Apple, for example. Do you think Apple's going to be a top 10 company in the United States in 20 years? I would have thought yes. It's hard to believe when I take my iPhone out of my pocket and give my kids an iPad and we turn on our Apple TV and my wife's looking at her calendar on her MacBook, that's not going to be a top 20 company. But you know what? That little anecdote tells me there's a 90% chance that they won't be. And it's because of big secular trends like AI right now. But going back, we have computers. We have the start of the internet. We have mobile technology. We have cloud computing. AI is the next iteration of that, artificial intelligence. You've heard so much about it today, but what I can tell you is I joined Janus Henderson. I've been in the business for 18 years, but I joined Janus Henderson about 7-8 years ago. And I was meeting with a portfolio manager who's on our technology fund, his name's Denny Fish. Denny's incredible. If you want to give his name a quick Google, I'd encourage you. Anytime he writes something or he's on TV or he's on a podcast, listen to what he says, read what he says. I think he's an incredible investor and really sees the future in the world of technology. And he was talking about a lot of themes that I was hearing in technology 7 or 8 years ago. Digitalization of the economy, e-payment, cloud computing, but he was also talking about AI. And that was back when AI was kind of a funny thing for us to talk about. Like we talk about the Terminator and the computers taking over the world and coming to get us all. That's still on the table, by the way. I haven't ruled that out yet. But he was talking about this trend of AI, and I didn't know what that was. And then as time went on, I started to learn what it was. And then instead of not knowing what it was, then I got scared of it. Because a lot of what you heard on ChatGPT a year ago, 2 years ago, was around school. I have 4 kids. My daughters are 11, 9, and 8, and my son is 5. And I started thinking about what becomes of them, what becomes of school, what becomes of their brain if they don't have to write an essay, if they can just plug a prompt into ChatGPT and it can write it for them. And I thought that's kind of heartbreaking. And an important thing to know how to do is to write and to think. And I was scared of it until I saw a video probably 4 or 5 months ago, and it was a teacher. And she was comparing the invention of ChatGPT with the invention of the calculator. And her argument was that when the calculator was invented in 1967 by Texas Instruments, there was real fear that people aren't going to know how to do math anymore. And you know what? They were kind of right. If you asked me to do long division right now, I'd probably struggle a little bit with that. But when you take a step back and you realize that the calculator made all the math better, you think about how much more quickly students can progress through different subjects in math. You think about physics, calculus, trigonometry, the impacts that it's had on different sectors like technology, like healthcare, like financials, how much better the calculator has made everything. It's the same thing for AI and ChatGPT, but it's times a multiple 10 to 15. That's how big of an impact that this is going to be. One of the members of our technology team said that AI is going to be the biggest economic development that we've seen in the United States since the Industrial Revolution. And that's why we're all talking about it so much. So where are we today with AI? Right now, we are in what I would call the first derivative. Some might say the first or second inning. Companies like NVIDIA, companies like AMD, and then we have the developers, companies like Meta, Alphabet, Amazon. These are the companies that are developing AI technologies, and we have the chip makers that are powering that development. So all obviously extremely important and very profitable if you're in these different sectors. But again, I think we're really, really early in this. And now, what happens over the next 10 years? Well, it's going to be, what does the integration of AI look like across every sector, across every company? Think who integrates AI better. Is it going to be Caterpillar or John Deere? Is it going to be Walmart or Target, Home Depot or Lowe's, JP Morgan, Bank of America? Who integrates AI better? That is the secular tailwind over the next 10 years. So now you can see I've gone full circle. I didn't know what it was. Then I was scared of it. Now I'm unbelievably excited because from what our investment folks are saying, this is not a story that's going to play out over the next 25 years. This is going to play out over the next 5 to 10 years. It's here, it's coming, and it's super exciting to see what kind of productivity gains can be had. And this is going to be the thing that, could be the biggest secular tailwind that we've seen in any lifetime. So really exciting there on AI. Just wanted to dive a little bit deeper. I just get choked up when I talk about AI. So let's talk about the vital signs of the economy. So when you go to the doctor, they're going to check your pulse, they're going to check your heart, they're going to check your oxygen levels, your temperature. Let's do the same for the economy. So I'm going to break it into 4 different parts. We have growth, profits, jobs, and inflation. So we're going to take those one at a time. Let's start with growth. Think about GDP in the United States. Q1, quarter one GDP in the United States was actually negative, 0.5%. Didn't catch a lot of headlines because there was one very good reason for that. And it's because imports, the import number, if you remember back to your economics 101, we have investment, we have government spending, and then we're going to have exports minus imports. Imports are a negative for US GDP because we're buying in from other countries. So imports were off the charts in Q1. Does anyone have a guess as to why we would have imported a whole bunch of goods in January, February, and March of this year? Anticipation of the tariffs. This was telegraphed. Corporations knew it was coming, so they accelerated a lot of their buying in Q1. So it was a negative GDP print in Q1. We're expecting that very much to level out over the course of this year, but we don't know. There are a lot of different predictions around what GDP looks like for this year in the United States. There are 12 Federal Reserve banks around the country who prognosticate on this, and the spectrum is the most optimistic is the Atlanta Fed, who is expecting 2.4% GDP growth this year. Then we have the most pessimistic in Philadelphia, which is 1.4% GDP growth for this year. 1% may not sound like a lot, but that's a $300 billion difference in expectations around GDP growth. And that is fueled by the fact that we have a lot of uncertainty around these tariffs. We have a number of deadlines that are coming up. August 1st is the next one for most countries, August 14th for China. We don't know how this ends. We don't know when it ends, and we don't know what the tariff rates are actually going to look like. So just expect some volatility around US GDP growth and tariff announcements. We saw it this morning, struck a deal with Japan, and the markets in the Nikkei were up significantly. And last check, US markets were up significantly as well. Look like really good buying opportunities at this point, but expect more volatility there. So that's what's happening on the growth side. In terms of profits have been good. Earnings have been strong. So far, about 16% of companies have reported their Q2 earnings. We're seeing 83% surprise to the upside in earnings for US companies, which is a good number. Guidance was down coming into this. So if we are right on track for expectations in terms of earnings in the US equity markets for Q2, it's going to be a 5.6% growth year over year, which is going to be fairly low compared to the last few years, but we're expecting onwards and upwards from there, especially with AI integration, more margin coming from that, more productivity. So we do like the US equity markets here. Little bit expensive. Total US equity markets trading about 22 times PE ratio, which is sort of the measure for how you're going to say whether the market is expensive or cheap. Slightly expensive right now, but here's what's really interesting is correlations between US stocks are down. There was a time for 8, 9, 10 years when interest rates were extremely low, when US stocks were more or less moving together, almost as one. We've seen correlations really drop, and now it's been a lot more about fundamental investing, and we're seeing each company is being traded on based on their own fundamentals. Here's a great stat for you. This is when I know I'm at my nerdiest. S&P 500 so far this year, there are 255 companies that are positive, have positive performance for the year. 245 companies that have negative performance for the year. For an actively managed asset management firm, that's a sandbox for us. That is an opportunity to pick the winners and avoid the losers, to take advantage of some unbelievable opportunities out there now that we have, again, a drop in correlation among stocks in the US equity market. So that's what's happening from a profit standpoint. Jobs, unemployment rates, 4.1%. 75-year average is 5.8%. And they call, when you get to unemployment between 4 and 5%, they call it full employment. I don't know that anybody knows exactly what full employment means, but I will tell you this. Yesterday, I had a meeting in Philadelphia. There were two of us. We were getting coffee, and we walk up to the barista, and he was looking at his phone, and we said, hey, can we just, 2 cups of coffee, please? He looks up, hands us the cups of coffee, punches it in, turns it around and looks back at his phone, and it asked if we wanted to tip him 20, 22, or 25%. That's full employment to me. That's, if that guy's working, that's full employment. So I think the employment picture looks pretty strong here at this point. And we'll see what happens. I mean, I think we are at a point where you're going to start to see some of the government job cuts that are going to work their way through the system. So you could see that number tick up here a little bit. You also have tariffs that are going to hurt margins. So would expect unemployment rate to tick up a little bit, but still in a really good spot here right now. And then the last point I have for you is inflation. Inflation right now annualizing at 2.7%, between 2 and 3%. I think that's right about where the Federal Reserve wants us to be. So we're in a good spot there. And we'll see what happens. There's some inflationary measures out there. Tariffs could be inflationary. Budget Reconciliation Act could be inflationary. So we could see inflation tick up here a little bit, but I think inflation's important. If I'm in your shoes, I'm thinking, okay, I care about rates for 2 main reasons. Number 1 are my savings rates, and number 2 are my borrowing costs. Your savings rates, think about your money market, probably somewhere in the high 3s, maybe low 4s. And as the Federal Reserve moves that rate up and down, you're going to see that savings rate move up and down accordingly. And we saw that, right? We've seen 125 basis points, 1.25% of Fed rate cuts here over the past year. And we saw our money market rates come down accordingly. And so what does the Federal Reserve do here? Do they cut rates? Do they increase rates? Right now, what the market is pricing in are 2 quarter-point rate cuts. So that's 0.5% rate cuts by the end of the year. At Janus Henderson, that is not what we think is necessarily going to happen. We think it's either going to be 0 or 1. Jerome Powell, the Fed chair, we think he's stuck between a rock and a hard place right now, where I think in a vacuum, he'd like to lower rates here, but he's unsure of the impact of tariffs on inflation. If tariffs proves to be inflationary in the short term, that's going to cause the inflation rate naturally to go up. And he might be in a situation where he'd have to raise rates. So he doesn't want to cut rates only to have to raise them very quickly after that, because that would signal some uncertainty in the markets. So we think it's going to be higher for longer for the Federal Reserve. But then as we move further out, we look at the 10-year Treasury rate, and the 10-year Treasury rate's a good bellwether if you're thinking about your mortgage rates, home equity line of credit. If you're looking at any kind of business borrowing costs, if they're not floating rate, any kind of fixed rate borrowing you would do, that would be the 10-year Treasury right now around 4.3%. And we think that is going to be more or less range bound here, aside from any kind of a macro shock to the market, be it geopolitical or financial. So we do think higher for longer, which is good news. So in sum, I would tell you, we really like the U.S. equity market over the next 5 to 10 years. There's going to be some short-term volatility. There's no shortage of things. I'm sure with all of us in this room, we've come up with a whole list of things that are going to cause volatility and ups and downs. But we think the long-term in the U.S. equity markets look unbelievably exciting to us, and onwards and upwards. So happy to take any questions, but thank you. Yes, sir. Oh, sure. It's a portfolio manager. His name's Denny Fish. Exactly like it sounds. True. All right. Thank you, everyone, for your time.
How was your chance to we had some
We have a Zoom
we have a Zoom question.
For both of you, how concerned are you both about the growing national debt? Whoever wants to tackle it first.
Concerned, for sure. I think there's a couple ways that you could, I guess the more important question is, how do you get out? And that's a little bit more tricky. And so there's a couple different ways that you get out of it. If the debt exceeds so high, there's really only 3 ways that we can really sort of get out of situation that we're in. One would be default, right, on the loans that you have, which they're not gonna do that because it would hurt the credibility of the United States dramatically. So that's probably not an option. You could repress growth and pay this debt off over a long period of time, similar to what Japan's process was. And they'll pay it off over a long time. Or the last option, and what the US has decided to do, is to try to grow themselves out of that situation. A little bit tricky, not from the last, I think that's probably the best scenario. You accelerate growth, you have your debt servicing lower, and slowly the deficit goes down. And that's what the way they're gonna do. Consequence of that kind of scenario that they're setting up is slightly inflationary. So we have to be, just as Dan said, I heard him say, a little bit more inflation for longer. I think that's a probability out there that can happen. There could be some offsets to that, but I'd say generally speaking, that's how I position. That's the way we decide, or not the card, not we. Once we decided. Any other questions?
Questions for both of them? It's your time to challenge them. Nothing? All righty.
Thank you,
guys.
thank you.
They did a tremendous job. It's interesting because as an advisor, I meet with families and somebody entrusts you with their nest egg, and I need to help them sleep well at night, right? Market volatility, things are ever changing. And when somebody entrusts you to take care of their retirement savings, well, I need to sleep well at night, right? Knowing I'm doing the right thing for them. Aligning ourselves with partners like this, amazing companies, is how I sleep well at night, which I can pass through to my clients for them to sleep well at night. Another thing I think about is, as you know, past performance doesn't guarantee future performance, but we think it's a good indicator. So when we partner ourselves with companies like this who have 20-year, most of them longer, but a 20-year longer track record, that gives us the ability to see these companies' ability to handle volatility, recover, and maintain good returns. And we can all agree over the last 20 years, we've had a lot of significant volatility, right? And we've also seen these companies' ability to pivot and do the right thing and keep those strategies on track. Another thing that I reflect on is, we talk a lot about the companies and their ability to help, keep the investments doing well, but in turn, FIP celebrating 30 years. And over 30 years, investments change. Well, sometimes this fund's great, and now it's not so great. Of course, not their fund, but I'm just. But again, management, styles, things like this are always changing. And at FIP, what have we done? We're the quarterback. We're not building the strategies, we're managing the players. So over 30 years, I pride myself and our firm and everybody I work with in our ability to actively review your investments and make the necessary changes. I think it's a testament to why over 30 years we've only grown significantly, because even though we're not managing the specific strategies, we've made the appropriate changes for our clients to continuously be on track to their long-term goals. Very briefly, I know it's cake time and we've heard a lot today. What's our investment philosophy? It all starts with tailoring all of your accounts to your risk tolerance and time horizon. I believe allocation is 90% of the return, and making sure you're comfortable regardless of what the market's doing. I like to say many of our portfolios are all-weather portfolios because when it's tailored to you, whether the market's going up or down, it's tailored to you. You have enough growth or protection that it should either participate in the market or have enough protection for you guys, regardless of what the market's going to do. And then we, of course, monitor that extremely regularly. We have an amazing investment committee that meets monthly. Something we get credit from whether it's other mutual fund companies or other advisors is, I don't have 50 models. I don't have a special model for everybody. We have the same high level models for all of our clients. Whether you have 100,000 or several $1 million, all of our clients get the best idea. And that's how we ensure consistency, because as you know, that's what we care about a lot. Same experience. So our investment philosophy, and on your reviews, we look at those track records, and I can confidently say that the models have really done well. I'm not here to hit you home runs. We're here to get you around the bases safely. So with that said, I know we have many more fun events coming up. It's our 30th anniversary. Shout out to my dad. Townhouse, buy and sell. It's not easy. Every day, that's another story. But he's just helped grow such an amazing community of clients, team members, and we're all really proud of him. And again, as I said, we're really excited for the next 30 years and continuing our partnership with you guys. So thank you for coming today. I hope you guys continue to enjoy your summer. And as always, anything you need, you'll let us know, okay? There's extra stickers as we are now.